Hello, and welcome to my video on using the multi-step income statement to compute gross profit rate and profit margin with PepsiCo's 2019 annual report. In Chapter 5, in your text, we see a multi-step income statement, the first part of which calculates gross profit by looking at sales, net sales. Remember, that's sales minus any sales returns and allowances and discounts. Usually on the income statement, they only give you net sales, not the details about discounts and allowances. We have a gross profit after we deduct the cost of goods sold from sales. We have various categories of operating expenses used in day-to-day operations: salaries, utilities, advertising, depreciation, freight out, and insurance. After we deduct operating expenses from the gross profit, we have income from operations. We have non-operating activities that aren't necessarily involved in day-to-day operations, other revenues and gains like interest revenue or a one-time gain on selling plant assets, other expenses and losses like interest expense, which is a finance expense, and casualty loss from vandalism. They don't happen all the time. After that, we have income before income taxes, we deduct income tax expense, and we get net income. Let's see what this looks like on PepsiCo's 2019 financial statement. Notice we have net sales. We don't have any details about gross sales and sales returns and allowances and sales discounts. After deducting cost of sales from the net revenue, we have gross profit. For our operating expenses, these are selling, general, and administrative expenses. After we have gross profit minus operating expenses, we get operating profit. We have some non-operating expenses, including other pension and retiree benefits and interest income and expense. Before we deduct from operating profit the non-operating activities to get income before income taxes, deduct the provision for income taxes, and then we get net income. And we want net income that's attributable to PepsiCo if you owned one share of stock. You'll see down below that they actually tell you what it is on a per share basis, and we'll learn about that in a later video. For now, we're using multi-step income statement to calculate profitability ratios, which measure the income or operating success of a company over a period of time. The first one is the gross profit rate, which is gross profit over net sales. The multiple step income statement makes this easier to calculate. So for PepsiCo, we were given the gross profit. If it's not given to you, take sales minus the cost of sales. So 37 billion divided by net sales of 67.1 billion gives us a gross profit rate of 55.1% in 2019. Gross profit of 35.3 billion divided by 64.7 billion in net sales gives us a gross profit rate of 54.6% in 2018. So for every dollar of net sales in 2019, Pepsi has 55.1 cents left over after deducting the cost of goods sold. Remember, this 55.1 cents of gross profit must cover all the other expenses before there's net income for shareholders. So that's just looking at the direct cost of goods sold deducted from sales. Using the gross profit rate, PepsiCo was slightly more profitable in 2019 than 2018 because it had a higher gross profit rate in 2019, not by much. Another profitability ratio is the profit margin. Instead of looking at just the gross profit, we want to say, what's the bottom line? Net income divided by net sales after you deduct all the expenses. The multiple step income statement again makes it easier to calculate. We're going to use the net income for common shareholders of PepsiCo, which was 7.3 million in 2019, divided by net sales, $67.1 billion. That gives us a profit margin of 10.9%. In 2019, for every dollar of net sales, PepsiCo has 10.9 cents left over for common shareholders after deducting all expenses. What you'll notice is in 2018, PepsiCo has a lot more. It has 19.35 cents left over for common shareholders. Using profit margin, PepsiCo was less profitable in 2019 than 2018. However, there was a really unusual reason why profit was high in 2018. There was a one-time tax benefit in 2018 due to the Tax Cut and Jobs Act, and this wasn't due to improved operation. So it's kind of a fluke that the profit margin was higher. It was due to a one-time tax benefit rather than improvement in operations. Please feel free to review this presentation before looking at other companies' annual reports for the weekly discussion board. Good luck, get started, Jaspers, and I will also put a PDF of the PowerPoint slides on Moodle.